Welcome back to the Pi Uncut podcast, where we dive deep into the forces shaping the economy, financial markets, and your investment portfolios. I'm your host, and today we're tackling a pivotal moment for investors: the Federal Reserve's anticipated interest rate cut, expected to be announced on September 18, 2025. This is the first rate cut since December 2024, and it's been one of the most anticipated monetary policy moves in recent history. With a 96% probability of a 25 basis point cut and a 4% chance of a 50 basis point cut, according to the FedWatch tool, markets are buzzing with speculation. But the real question is, how should investors position their portfolios to capitalize on this shift? In this episode, we'll explore the historical context of rate cuts, their impact on global and domestic markets, sector-specific opportunities, and actionable advice for navigating this new environment. Let's dive in. Historical market context. To understand the significance of this rate cut, we need to step back and look at the Federal Reserve's dual mandate: controlling inflation and maintaining full employment. A few years ago, inflation soared to nearly 10%, driven by supply chain disruptions, energy price spikes, and post-pandemic demand surges. Since then, the Fed's aggressive rate hikes have brought inflation down to a manageable 2.5 to 3% range, close to their 2% target. This is a remarkable achievement, but the labor market is now showing cracks. Unemployment has crept up from 4% a year ago to 4.3% today. Job creation stalled with a loss of 13,000 jobs in June, and wage growth has slowed to 3.7% in August, the lowest in over a year. Historically, rate cuts signal a shift from tightening to stimulus, often sparking market rallies. During the 2001 dot-com bust, the Fed cut rates from 6.5% to 1.75% over a year, fueling a recovery in equities, particularly in real estate and technology. Similarly, post-2008 financial crisis cuts drove a decade-long bull market. However, this rate cut comes in a unique environment. The S&P 500 is at record highs, trading at 23.5 times forward earnings, well above the 10-year average of 19 times. Gold prices are also at all-time highs, and Treasury yields are declining as investors shift to short-term securities. This suggests markets have already priced in much of the expected cut, raising the risk of a sell-the-news event. Globally, rate cuts in the U.S. tend to have ripple effects. Lower U.S. rates weaken the dollar, boosting emerging market currencies and commodities priced in dollars, like oil and metals. However, with Europe and Japan facing their own economic challenges, including sluggish growth and persistent inflation, the global impact of this cut may be muted compared to past cycles. Investors must weigh these dynamics carefully. Market impact. The immediate market reaction to the Fed's rate cut will likely depend on the size of the cut and the Fed's forward guidance. A 25 basis point cut, as expected, may lead to a short-term pop in equities, particularly among retail investors caught up in the excitement. However, professional money managers may sell into this rally, given the S&P 500's elevated valuations and the anticipation already baked into prices. Over the next 30 days, we could see volatility, especially if dissenting voices within the Fed signal uncertainty about further cuts. Looking medium-term through the end of 2025, there's reason for cautious optimism. A staggering $7 trillion in cash is sitting on the sidelines, parked in high-yield savings accounts, CDs, and money market funds. As the Fed lowers rates, yields on these risk-free instruments will decline, potentially pushing a portion of this capital into equities. Even a small fraction of that $7 trillion could ignite a year-end rally, particularly in sectors sensitive to borrowing costs. However, risks remain. The labor market's weakening signals, rising unemployment, and slowing wage growth could dampen consumer spending, which drives 2/3 of U.S. GDP. A consumer-led slowdown could weigh on corporate earnings, especially for cyclical sectors like retail and consumer discretionary. Additionally, persistent supercore inflation, excluding volatile food and energy prices, could limit the Fed's ability to cut rates aggressively, keeping borrowing costs higher than some investors hope. Sector analysis. Lower interest rates reduce borrowing costs, benefiting sectors that rely heavily on debt financing. Let's break down the key sectors poised to outperform. Real estate investment trusts, REITs. REITs are particularly sensitive to interest rate changes due to their reliance on debt to acquire and manage properties. Lower rates reduce financing costs, boosting profitability and enabling expansion. The document highlights two REITs, VCI Properties, VCI, and Equinix, EQIX. VC Properties. As the largest landlord on the Las Vegas Strip, VCI owns iconic properties like Caesars Palace and MGM Grand. Its resilience during the pandemic, with 100% rent collection, underscores the quality of its tenants. Trading at a forward price to funds from operations (PFFO) ratio of 13.8, in line with its 5-year average, VCI appears undervalued given its revenue growth to $3.9 billion and FFO of $2.76 billion. Lower rates could push its valuation closer to 16 times PFFO, offering upside potential. Equinix. The largest data center REIT by market cap, Equinix is riding the AI-driven demand for data infrastructure. Despite a 16% year-to-date decline, its revenues hit $8.9 billion, with FFO at $3.66 billion. Trading at a forward PFFO of 20.2, well below its 5-year average of 24.2, Equinix offers a compelling growth story at a discounted valuation. REITs, required to distribute 90% of taxable income as dividends, also provide attractive yields in a low-rate environment, making them a dual play on growth and income. Home builders and related industries. Lower rates stimulate housing demand by reducing mortgage rates, benefiting home builders, material suppliers, and home improvement companies. As more buyers enter the market, demand for construction materials and home furnishings rises, creating a trickle-down effect. Stocks like D.R. Horton or Home Depot could see gains as housing activity picks up. Small-cap stocks. Small-cap companies, often more leveraged than large caps, benefit significantly from lower borrowing costs. The iShares Core S&P Small Cap ETF IJR, with $85 billion in assets, targets high-quality small caps poised to grow into mid-caps. Up 11% in the last 3 months as rate cut expectations solidified, IJR's focused portfolio of 600 holdings offers exposure to dynamic companies without the baggage of broader small-cap ETFs like IWM, which includes over 2,000 stocks. Defensive and value sectors. With market valuations stretched, defensive sectors like utilities, healthcare, and consumer staples may offer stability. These sectors tend to perform well when growth stocks falter, as investors seek safety. Value stocks, trading at lower multiples, could also outperform if high-growth tech stocks face a pullback. Investor advice. Navigating this rate cut cycle requires a balanced approach. Here are practical strategies for investors. Rebalance your portfolio. Avoid trying to time the market by going all in on cash or equities. Instead, reduce exposure to high-growth, high-valuation stocks, e.g., tech giants trading at 30-plus times earnings, and increase allocations to defensive and value sectors. Consider adding REITs like VICI and Equinix for their income potential and growth prospects. Focus on quality. In small caps, prioritize ETFs like IJR that focus on high-quality companies with strong fundamentals. Avoid broad-based funds that include poorly managed firms. For individual stocks, use tools like Fiscal.ai to research revenue growth, cash flow, and valuation metrics before investing. Capitalize on the $7 trillion opportunity. As yields on savings accounts and CDs decline, redeploy cash into equities gradually. A dollar-cost averaging approach can mitigate the risk of a near-term pullback while positioning you for a potential year-end rally. Monitor the labor market. Keep an eye on unemployment and wage growth data. If the labor market weakens further, consumer spending could falter, impacting cyclical sectors. In this scenario, overweight defensive sectors to protect your portfolio. Stay disciplined. The anticipation of this rate cut has driven markets to record highs, but a sell-the-news event could trigger volatility. Stick to a long-term strategy and don't get swept up in short-term market euphoria. Conclusion. The Federal Reserve's expected rate cut on September 18, 2025, marks a turning point for markets, but it's not a blank check for unbridled optimism. With inflation under control but the labor market showing signs of strain, the Fed is walking a tightrope. Investors should prepare for short-term volatility but remain optimistic about medium-term opportunities, particularly in REITs, home builders, and small-cap stocks. By rebalancing portfolios, focusing on quality, and staying disciplined, you can navigate this shifting landscape with confidence. What are your thoughts on the Fed's move? How many rate cuts do you expect by year-end? Drop your comments below and don't forget to subscribe for more market insights. Until next time, stay sharp and invest wisely.